So hello and welcome friends to this new chapter of CFA level 3. This chapter is called Capital Market Expectations. Now here this term has two parts. One is the capital markets and second is the expectations. So first let us understand what do we mean by capital markets. Capital markets is basically a collective place where a meeting happens. Meeting between the capital providers and the users of capital. Capital providers means retail investors, HNI investors, institutional investors, debt providers, all these providers of capital who want to invest their money or lend their money, right? Then there are users of capital. Who are users of capital? It can be businesses, it can be individuals, it can be governments. What can be the users? Individuals can take loans for education, for some consumption, for business. Institutions can take loans for expansion, for business, for taking the benefits of leverage. Sovereigns can also take loans. They can take loans to do infrastructure projects, to do welfare, etc., to make up for the deficiency, etc., etc. So we have understood who are the capital providers and who are the users of capital, and both of them are overseen by certain entities who are called the regulators. Let's say for an individual taking a loan, the bank is the provider of capital, the individual is the user of the capital, and the regulator can be the government or the banking system. Now let's say an IPO is getting issued in USA. An IPO is getting issued in USA and there is an individual who is investing in this IPO. Now this individual here in this case is the provider of the capital. The business who is issuing the IPO is the user of the capital and the regulator is SEC. Another example can be, let's say a company is issuing bonds. Now the company which is issuing bonds is the user of the capital, and the people who buy those bonds, who invest in those bonds, are the providers of capital. And obviously the regulatory bodies which are guiding that entire transaction are the regulators, and these three primary bodies form the capital markets. Now what are the things or what are the instruments through which these kind of capital market transactions happen? Majorly these transactions happen to instruments like stocks and bonds, and apart from that instruments like derivatives and commodities are also invested upon, right? Now the capital markets part is clearer for us. Now what is meant by expectation? The second question is, we know what is capital markets. Now what do we mean by expectations? So an example of expectation of capital markets can be, let's say you are looking to buy in Forex and there is a currency XYZ which you are betting against. There is a currency XYZ which you are betting against and you are actually long the US dollar, right? You think US dollar is going to appreciate in comparison to XYZ, right? So what you do? You sell the XYZ and you buy USD. You sell XYZ currency and you buy USD. That's what you do. Now this transaction you did based on certain assumption that USD is going to appreciate, right? This is what we mean by expectation. This can be against currency, this can be against commodity. Let's say you are trying to bet on oil, you are trying to invest in oil. Now you have to have an expectation of what is going to be the price of oil in the future. Let's say you buy at an X price and then you want to sell it at an Y price, right? Now the expectation for the Y you have to set, right? So this is called capital market expectation. Or let's say you are investing in a stock, you are doing swing trading in a stock and you are holding a stock for let's say 40 days. Now you expect that stock to go up 20%. This is another capital market expectation. From the point of view of an asset manager, let's say you are trying to create portfolio for your clients. Now you are trying to set expectations on both fronts. One front is, what are the goals of this client? And the second front is, where should we make investment so that these goals are fulfilled? This is also based on capital market expectations. You are first understanding what is the goal of your client, then you are trying to find out the asset universe where you need to invest for those goals to be fulfilled in the highest sense of probability. And this probability is based on certain expectations you have from those assets. Basically, you are setting expectations for capital markets. So this is what we holistically mean by capital market expectation. Now, setting of capital market expectation is a very intricate job if you want to go into the details. So what we'll do is we'll start with a framework for setting up capital market expectations, know what are the steps for it, then understand what are the limitations of it, and then take it further into more details and expand into how to create capital market expectation. So let's get started.
The link to the full class video is given in the description below. Please check that out. Thank you so much friends for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships and CFA curriculum classes, check the description below. Till then, keep watching Finnovation. See you in the next class.